Hey guys, Mr. Sailors, and here we are again for a digital learning day for our new unit on monetary policy. Who knows what day it is, really? Wow. Anywho, I hope you're staying home and staying safe. Word on the street is no teenagers are doing that. Y'all are all still hanging out together, so please just stay home. This thing will get over sooner. Anyway, with that being said, so here's kind of the breakdown in macro. Right here, as you can see, as it's split up. We have fiscal policy, government spending and taxes. Who does that? The president and Congress. And it does have potential to be slow, some lag times. Except recently when they really fast tracked that $2 trillion spending bill, which we would see as discretionary. Now, over here is what we're focused on. It's called monetary policy, which is control of the nation's money supply. Who does that? It is the U.S. Central Bank, which we call the Federal Reserve. Now, here's kind of the breakdown right here. Let's look at these notes. Is the Federal Reserve is a central bank. It's an institution designed to oversee our banking system and regulate the quantity of money in the economy. And so this is done through control of how much banks have to loan out. This is what they're doing. They either supply more money to banks to loan out or they supply less. They are known as the lender of last resort, which we're going to talk about. And so the U.S. Congress described three key objectives for the Federal Reserve. They are to focus on maximizing employment, stabilizing prices, and moderating long-term interest rates. They call it the dual mandate. Yes, I know there's three things there. But stabilizing prices and moderating long-term interest rates generally go together. The Federal Reserve System is broken down into two components. There is a Board of Governors, which consists of 7 members, all right, who have 14-year terms. Think about that. The head of the Board of Governors is named Jerome Powell, and thus he's chairman of the Federal Reserve System. They are located in D.C. Then you have the 12 member banks located around the U.S. I showed you that map yesterday. Each bank has a president, and they serve for 5-year terms with a mandatory retirement at 65. There is exceptions. Now, the main thing they do is they join together every 6 weeks in the Federal Open Market Committee, and they decide whether to just two things: increase the money supply or decrease the money supply. That's really it. And they're going to take a lot of variables in to decide this. And who decides this as a committee would be all 7 of the Board of Governors and 5 of the 12 regional bank presidents. The New York bank president has a permanent seat because that's where Wall Street is. So that's the setup. Once again, to repeat, there is a 7-member Board of Governors located in D.C., and you have the 12 banks spread out throughout the U.S. So, and I showed you that map yesterday. Now we're going to show you what they do to increase or decrease the money supply and when would they do that. So this is what hit the news, which is so exciting, especially as an econ teacher, is the Fed did a lot of stuff about 2 weeks ago. First thing they did is they said they used the word inject. They injected the banking system with $1.5 trillion. They lowered interest rates to 0 and told banks not to worry about the reserve requirement at all. So you can ignore that, is what they said. And lastly, they actually funneled U.S. dollars, traded U.S. dollars for international currency. So what they're basically saying is, through all of this, is the Fed is saying, don't worry about cash, world, U.S., because the Fed has got your back. Because basically, the Fed has unlimited money. It's literally unlimited. But here's what they want you to do. They want you to just don't stop loaning out money, banks and globally. We got you. And because what they've noticed is, and I really learned about this in '08, is that when times get tough, banks, people, international organizations, they want cash. And the most stable cash in the world, believe it or not, is the US dollar. More than any other currency in the world, all right, it is the US dollar. Okay? So people want cash. So they hold on to their cash. And if you hold on to your cash, you're not doing what? You are not loaning it out. So the Fed is saying, like, you don't have to worry about your cash. We got cash anytime you need it. Loan it out. So the Fed is basically like Gabe's parents. Anytime he needs money, he just asks for it and he doesn't have to really worry about it. So there you go. It's another way to think about it. Another way to kind of think about what's going on is like you right now, and someone comes to you and wants to borrow $100, you kind of don't know what's going to happen over the next couple weeks. So you're probably going to say, no, I want to hold on to this $100 rather than loan you out. But if you have Gabe's parents and you can loan the money out and you just go to them and get the $100, this all works out really easy. You're more likely to loan that money out. So that's basically what is, of course, going on. Now, how do they do all this stuff? All right? And this is what we're going to look at. And this is your assignment for today, is to copy down notes. So let's look at these notes. So this is where you start writing down these notes, and you're going to take a picture of these notes. All right, this is page 1 of these notes, and you're going to show it. You got to write your name on it, of course, so we're not copying, sending the same notes around to me. Put your name at the top and take a picture and send it to me. The main tool that the Fed uses is something called open market operations. It's the buying and selling of bonds. Bonds are also known as securities. All right? So when the Fed buys bonds, this increases the money supply. And when they sell bonds, this decreases the money supply. So a little way to remember this is buy bonds equals big bucks, sell bonds equals small bucks. So what the Fed is doing right now is they are buying bonds from banks. Because all these banks have these treasury bonds. You know how the federal government has all this debt? And if you remember when we did the crowding out effect, but the banks have all this debt, these bonds. Bonds are not money, by the way, but they're very safe investments, right? They pay an interest rate. And so they're sitting there and they have these bonds. And what the Fed does is they buy these bonds from these banks. And all these banks hold billions of dollars of treasury bonds, these treasury bonds, because if you know, there's a lot of bonds out there because the U.S. government is in now $24 trillion worth of debt. All right, we just upped that number by $2 trillion the other day. So they're holding on to these. So what the Fed does is they say, hey, we'll take those bonds off of your hands and we'll give you cash for it so you can loan it out. All right, to keep the engines of the economy rolling. And that's what they are doing right now. They are buying bonds. So they're basically, to go back to this slide, which you don't need to write down, is they're saying right now, the first thing they said, we got 1.5 trillion. You can loan us those bonds for a month and we'll give you cash. And that's what that is. And only so they didn't inject the economy really 1.5. They said it's here if you need it. Now, when they began to buy bonds, which is the second thing, this lowers interest rates, and we'll show you the graph later. This lowers interest rates to basically zero. That was their target, to get it down to zero. So when they buy bonds, we see, and remember you're copying this down, the federal funds rate, which is the interest rate that banks charge each other to loan from other banks, that begins to go down. All right. So this interest rate right here is basically near zero. So banks can easily borrow for each other. Now they get a little nervous doing that during recessions. So the Fed is saying, don't worry about it. We got your back. We are the lender of last resort. You don't worry. So what happens when they buy bonds, big bucks, the money supply increases, and the interest rate that banks borrow from each other lowers. And this is the main function, of course, what they're doing right now to get interest rates down to zero. But you see, the main thing is that banks need to loan out money. And so this is what the Fed is trying to say. Loan out, loan out, loan out. Now, when you can't really go below zero. I mean, you can, but I don't want to get into that. But you can't really go into below zero interest rates. So if we don't get out of a recession, there's less things that the Fed can do. I mean, this is their main thing that they can do is control interest rates. The second tool that they have, well, it's kind of two in one on that slide. You need to write down this next slide. Is they can control the reserve requirement. Now remember, this is how this works. When you deposit $100 into a bank, the bank is required to hold 10% of that $100 or $10 in their vaults, all right? And they can't loan it out. That way, if you go to basically, in essence, if you go to the ATM, right, there's money there, okay? So, so we can see if you raise the reserve requirement, let's say you go up to 20%, there's less money to loan out because you have to keep 20% in reserves. And if you lower the reserve requirement, you can loan out more money. And this is what I talked about. This is another tool they did. They said, don't worry about the reserve requirement, which you can see right here. And so they basically said, don't worry about it. Loan out all the money you have. And if you need money, just come to us, the Fed. We gotcha. Don't worry about it. Even though going to the Fed is kind of like not a good thing if you go to lender last resort, the Fed is trying to tell everybody, hey, that card doesn't play right now in a recession. Anyone can come with us. So they're lowering the reserve requirement down to zero to increase the amount of money to be loaned out. So basically, the reserve requirement is almost at 0% right now. This is a temporary thing. And there's plenty of money. The Fed's got our back. So you don't worry about the ATM at all. You can go take out all your money, and guess what? It's no big deal. All right? There's no bank runs, anything like that. So you don't have anything to worry about. So that's another thing that they are doing. The next thing is if you go to the Fed. The Fed has an interest rate that you can borrow from them. All right? So you can go to other banks. If you're a bank, you can borrow money from other banks, or you can borrow directly from the Fed. And the Fed has an interest rate, and that interest rate is called the discount rate. And basically, that interest rate is zero. The Fed is, so they've lowered this interest rate right here to zero, and thus increasing the money supply. They want everyone to loan out. All right? So this is another one right here. You need to write down this slide. All righty. And then another tool they created, which I don't even think is tested yet on the AP test, but I want to tell you about, is interest on reserves. The Fed will pay interest to banks on their reserves. So if they increase this interest on the reserves they're not loaning out, this will decrease the money supply. And if they decrease the interest on reserves, this increases. So you can imagine what they're doing. They're not giving they're not giving banks any money to hold on to their money because they want it to be loaned out. All right? So this is kind of what's going on right now with the Federal Reserve. They're trying to get banks to loan out money as much as possible for there. And hopefully once this thing lifts, hopefully by June the 1st or May the 1st, banks will obviously still be in business, but also small businesses, because it was easy for them to take out these low interest short-term loans. So make sure you write down this slide right here. We're not seeing this play as much as you can see. Now, just going back to this slide right here, they're trading U.S. dollars for international currency. So you have a lot of countries around the world who are hoarding U.S. dollars, and they don't want to loan it out or they don't want to trade it. And basically the Fed says, don't worry about it. We'll give you even more. So the Fed's actually giving U.S. dollars for international currency to keep the flow of money moving around the country. So this is kind of what's going on. And I know what you're probably thinking, and we kind of discussed this. You're worried about, well, with all this money, won't there be inflation? Well, you got to see, in essence, this could happen in the long run, but right now, where the Fed is increasing the money supply, at the same time, money's being sucked out of the economy, because we just saw 3 million people apply for unemployment insurance. So over 3 million people are not being paid salaries. People are not buying stuff. So money's not flowing in the economy, and the Fed's trying to replace it. If you're just replacing it, you generally won't see inflation. Keynes would argue that the SRAS is horizontal, and we've looked at that graphically. So just to go, you need to copy down this slide, right? This slide, and of course, this slide right here. Let's continue copying some stuff. And what is this called? So, what we're doing right now is the Fed is fighting a recession. It's known as expansionary monetary policy. You want to copy this slide down. And or it's called easy money policy. So you might hear the phrase quantitative easing. So what they're doing right now is they're increasing the money supply. If there was inflation out there, which there is not, they would do tight money policy or contractionary monetary policy. And you can look at the prior notes to see what they would do. Get down this slide. Next slide. Get down this. So inflation, they would decrease the money supply. So they would sell bonds, increase the reserve requirement, raise the discount rate, and raise the federal funds rate. Now, sell bonds, small bucks, easy to remember. But also over here, notice that whatever happens here, the opposite happens to the money supply. So look at a recession, which is what they're doing. Easy money policy, they're going to increase the money supply, which means buy bonds, big bucks, which means if they're going to increase the money supply, they're going to decrease. Alrighty? So basically, right here, you understand the Federal Reserve, and this is what most of the world doesn't understand about their central banks. You do now, so it's kind of pretty cool that y'all understand this. Tomorrow, we're going to get into some graphing, but remember your notes is to copy down these slides, this being one of them, and take a picture of it. So that is your assignment for today. Hit me up with any questions you might have. This is a little confusing. We're going to keep running with this, do a little graphing tomorrow with the graph that goes with this. Your last major graph, by the way, of this semester. And we'll start getting into balance sheets on Thursday. I know you're so excited. All right, miss you guys. Stay safe. Stay home.